To add or not to add? That is the question. Today's lesson of the day is when should you add to trades, how can you add to trades, and when should you maybe not? Everyone is always interested in making more on a trade, so you have an idea, you have a trade plan, you have an amount that you're willing to risk, you have an amount that you want to get in, and then all of a sudden, something changes, and you either want to buy more because it's gone in the money, maybe you want to buy more because it's gone out of the money, maybe you want to add to the position because something new has happened. So you've got to first understand which of those questions you're trying to answer, and then you can think about whether or not you should be adding to a position. Now, I shouldn't have to say this to anybody. Once you increase your position size, you are now risking more, right? So the only way in which you are not risking more if you add in position size is if your out becomes tighter. A visual example of that, because I think it's an easy thing to visualize, I'll just point out on a trade here on Amazon right now, because it happens to be sort of trending into the upside. If we can come to the chart, Ram. And chart. But if we're looking at something like this, if I'm going long in front of VWAP, and let's say VWAP is your stop, and this is like 176, like 30 or so, and if you're risking about 20 cents on a 50 long, essentially, you know that is going to be your risk point plus a little bit of slippage. Now, if for some reason I like that and I want to add to it without taking anything out back at the same price, if you double the position, you're doubling the out at 30. Now, if you were to move your stop halfway, then you're risking the same amount. So you have to understand, in that situation, the only way that you're risking less is to change your risk plan in terms of where you think you are wrong, which to me is the foundation of a trade. Where am I wrong? If you're arbitrarily moving that point simply because you have a different amount of shares, you're now doing something which is a cardinal sin. And you're thinking that the market cares anything about your position. The market doesn't care how many shares you have or what your new price might be. If it was going to hold a support level and that's what you're long in front of, that should remain your out unless you got new information. So if you are changing your out based on the amount of shares that you have and not an actual trade plan, all that means is you didn't have a plan in the first place, or you at least don't have a plan now. That is dangerous. The market's going to reward you sometimes for doing the wrong thing, and if you let it do that, you're going to find yourself in a world of hurt. So there's a couple of things to think about when you're adding to a position. What is the difference between averaging up and averaging down? You're going to hear those two things all the time in trading. So if someone is averaging down, that means you're entering into a position. Let's say, again, I want long in Amazon. It's trending to the upside, and it makes a top. I want to buy the dip. I go into a long position. It then goes down into VWAP. Now, I cover the trade and get back in. So I don't average down in this particular case. I take my hit, and does it set up again, I go back in. But if you were averaging in and that's your cup of tea, then you don't get out, and you get more as it goes against you. Now, the question you should be asking yourself is it part of your plan or not? If it's part of your plan, and let's imagine that same scenario that your out is down around here at 176.30, and your plan was to have a price of 176.50, but you didn't know exactly where it was going to turn, so maybe you're going to take a quarter at 70, and then another quarter down in front of 50, and then you were going to take another quarter underneath, such that if you got all in, you would still be risking the same 20 cents to that stop. That's fair. Because you were uncertain about the price movement, you wanted to make sure you got a piece into it, but you weren't going to be all in unless it got tighter to that 30 level or bounced higher and you could buy a little bit later. If it's part of your risk plan, fine. You determine what your out was, you determine the amount of shares you wanted, fair enough. However, if you simply averaged in because it happened to go against you and for no other reason, that's where you're going to get yourself into trouble. Because if you approach the stock with a plan of action that this is my exit, and this is how much I want to risk, and then you decide you want to risk more as it's going against you, dangerous way to approach things. Why? Because the trades that work out right away for you are the ones that you're not going to be all in on, and the ones that go against you right away are the ones that you will be all in on. So that's a dangerous precedent to set for yourself in trading. That's what happens with averaging down. So you can have a plan for it. Just make sure you're honest with yourself about what that plan might be. Now, averaging up's a different story. Averaging up can be a great way to play a momentum breakout. And I'm going to use an example of something that went, I mean, not everything's like a parabolic move. I'm going to use an example. I actually got a stop here in Google, but I wanted to show you guys something explosive where you might want to consider adding to a position. Now, if you average up, it's the same thing applying when it comes to risk to reward. If you are changing the amount of risk you have if you keep the same stop. So if you're long on a 139 breakout, which is probably the best break you could have on Google, it goes all the way up to 140. You're in that trade, you're holding for the dream, let's just say. You're like, yeah, I'm going to hold 25% or whatever amount you decide to hold on to, expecting unless it gets back underneath that breakout price, I think it can go to the moon. It's relatively strong. You can have all those reasons in the world. Now, when it bounces and reclaims VWAP, you might be thinking, hey, that's a good long. So there's two ways to approach this. One, be an algo and be able to treat the new shares different from the old shares. Meaning if I have 100 shares down here and I want to put another 100 shares there, I have my trailing stop for these, and when I end up with 200 shares, I have a different stop for that entry as if it was a separate trade. That's a pretty difficult approach mentally for a lot of traders because you're not a robot, but if you can do that, then it's all the same thing. You could have a tighter stop on that second entry, you could hold the original, no problem. Your average price is going to say something in here, and if you're married to that, you could find yourself in trouble. So approaching it as two separate trades is one way to go. Another way to approach that, which is very popular among momentum traders, is once it holds this bottom, you think that's another leg up, and you were going to trail the position anyways. Okay, it's breaking here. As long as it now holds that higher low, I'm going to hold on to this position. So if your original entry at 39 was going to be moved my stop to about 139.5 instead of break even, then that can be an opportune time to risk the same thing you did at that point. Whatever you've taken out here, you can add back in with a tighter stop, risk the same thing you did originally, and then get your continuation trade to the upside. The thing that works with that is you are working toward and adding and putting more risk towards something which is trending in the direction you were anticipating. Meaning you're trying to get more in a stock where you're not fighting the trend. Now, this, yes, can be fantastic, but make sure you have a plan of action. As I said, are you moving your stop? Are you treating it as two different trades? You might see a new entry point, but do you also see an exit point if it doesn't work out for you? Remember, when you add to a position, you are taking in more risk, so that requires you to have a new plan. Now, the last thing that I will talk about here is what happens if you get new information. That's always going to be important. There might be a situation where all of a sudden you hear news and it's going to move the stock. It's not always going to be the case, but every now and then you're going to see that happen. Now, in this particular case, I don't have an example from today where you had a position where I'm in and the news hits in the middle of the day and you think something different. But let's imagine a scenario here where you're already long in Alphabet, let's just say, and all of a sudden it bounces off of VWAP, but it's not a regular bounce. At this time, maybe news hits regarding like a TikTok divestiture. I mean, they had the vote today, so who knows? Like maybe there's news on TikTok. Maybe there's some great breakthrough in Gemini, and you're already in a long position, and you consider adding to it. In that particular case, whether you're averaging up or averaging down, you gotta do that whole algo thing. It's a separate trade at that point, because the old trade, you just happen to be in it. Like you just happen to be either in the money or out of the money when new news comes in. So if you're going to put new risk on, it should be its own trade 100%, because everything before the news event was different. So you've got to be able to take that anchor away from what was happening before, and if it's a new news event, wrap your head around a new trade. If you can't do it, you don't have to add. If you're sitting in the money and news comes out in your favor, bank error in your favor, there's nothing wrong with that. But before you add to that position, make sure you actually see a new trade and don't just jump on the euphoria because you already happen to have a positive P&L. That is, again, very, very dangerous. The market does not care what your P&L is. Never, and it never will. That's just what it is. And if you are averaging in, let's just say, when something is going against you, Let's imagine that you were shorting this stock on Alphabet. If you were shorting into 140.35 here, I'll use an example that wouldn't have worked. It was a gorgeous trade. You're short, it works. You're short, it works. Look out against the trend, higher low. Now, as it breaks that top, if you average into it up here, it goes back to VWAP, and oh yeah, baby, you probably make money going back into VWAP. But if it continues to press higher, remember, you're max in for your max pain in that situation. Think of it like roulette. Everybody understands the concept that you can go into a casino at a roulette table and bet on black, because that's what you should do. And if you lose, double the bet. If you lose, double the bet. If you lose, double the bet. And eventually, if it hits, you win the original amount of the bet, right? It's like a 50-50 shot. If you do that in trading, A, it's not a roulette table. It doesn't work that way. But in trading, you're going against the trend. This isn't an actual 50-50 bet or close to 50-50 bet. So if you're going to average into it like that, understand that yes, you're only going to need one turn and you're going to be good to go, but you will take max pain if you're doing it blindly when it goes against you. Everything is about risk to reward. Everything is about the ratio of winners to losers and the scope of your winners to your losers. So if you're going to add to positions, have a plan. Is it a new trade? Is it an extension of a trade I already have? Am I changing my out? Am I tightening my stop? Is there new information that makes it a new trade? Answer those questions and you can successfully add to your trades. That's your lesson of the day.